What's going on, everybody? In this video, we're going to be talking about how to invest in this economy that we're seeing, especially high interest rates, and two stocks that I myself am personally buying on the dip. We got a lot to go over in this video, so I'll ask if you enjoy dividend stock investing content and content just like this. Make sure to subscribe to the channel, yada yada. Not going to waste your time with that intro. Let's go ahead and get straight into the video. So what you're looking at right now is my dividend growth stock investing portfolio. It is down 5% this past week, and I'm recording this at 9:31 in the morning Eastern time. So the market's been open for 1 minute, and just the past day alone, I'm down 1.67%, which is about $180. But that's okay because I'm in here for the long term, and I'm not letting short-term trends scare me and make me want to sell my shares. So let's go ahead and talk about some news. The best stocks to own when interest rates rise from Morning Brief, and this is from this morning. And it says, guess what? Buy quality. And that is something I strongly agree with. I think especially in times like now, whenever the bull market has kind of ended and a lot of investors are starting to get a feel for stocks just not going up all the time, what you have to do is you can't just press a buy button and expect them to go up. You have to be buying value. So here are two stocks that I really see strong value in, and I think right now is the perfect time to get buying into. So the first stock on this list is going to be Starbucks, ticker SBUX. Now, I know that a lot of investors aren't necessarily the biggest fan of this company for a number of reasons, but I am a major fan of this company. Over the past year alone, and that's something I don't like to see, is that the stock is down 7.9%. But as you can tell, it used to trade at the beginning of the year in 2021 at 104, and it went up to about 116. It actually went all the way up to about 126. But over the past month alone, the stock is down 12%, 13% to be exact, honestly. They have a dividend yield of 2.04%, a market cap of 113 million, and a forward PE of 28. Now, looking on some dividend statistics, the grades on Seeking Alpha are not the best, but that's not going to cause me to not invest. Now, payout ratio of roughly 57%, a 5-year growth rate of 16.7%. That is a big attractive scale that I like to see on this company. I always love my dividends to be increasing. Dividend growth record of roughly 11 years, and they have an ex-dividend coming up next month on February 10th of 2022. Now, looking on some news, another reason why Starbucks stock is down is because one of their locations in New York decided to join a union. And this could hurt the company, But Starbucks, the management team has talked about they want to negotiate in good faith with Workers United, the union that they joined. And they plan on raising their average hourly rate from $14 to $17, which is going to potentially offset a domino effect that could make other locations join a union. Because if they do, it could mean higher expenses for Starbucks, which is not something that you want to see necessarily as an investor in the company. But they have a huge growth opportunity, especially in China. They opened roughly 1,200 new stores in 2021, and 664 of them were in China. So it shows that there's overall success, and this kind of goes towards China is it's a lot more locked down than a lot of other countries, you could say. And so with all these new openings, they're still waiting for the glass to be filled. And so there's potential to not only expand, but to fill up all the potential that's there. Transactions in the US jumped 19% year over year, and they're capitalizing on shift in consumer behavior by innovating the menu, and especially with things like plant-based meats and all of these different companies expanding their menus. Starbucks can definitely capitalize on this opportunity. Now, their growth opportunity, it's definitely there. They're adding more this is just potential ideas that they can do. It's not stuff that they're necessarily doing right now, but opening more stores in US and China, developed in developing markets, expand the drink menu and the food menu, the dollar number per transaction with inflation, so increase sales in that sense, facilitate repeat business through an easy-to-use application, and they do have mobile orders and different things like that, and then adding more drive-through stores in smaller footprints than in-store coffee house style locations, especially with the way that our world has transitioned, I guess you could say. It's a good idea for them to add more strictly drive-through options making people almost feel safer. Now, Starbucks on Morningstar has a fair value of $109 compared to their $96 current price. So it does give you a $13 upside, which is really good. Their margins are incredible. Their quarterly revenue growth year over year is really good, but it's also kind of put off by 2020 was just rough for them as a whole. Financials, really good. 2020 was a big dip, but back to 2021 levels in the trailing 12 months, levels of all-time highs on their revenue. Looking at all these expectations, very good. 12% expectation for 2022. Incredible stuff that we would like to see. Now, here are just some big numbers, like net revenues up 31% in Q4, comparable store sales up. Then they expected to get this $17 an hour payment by summer of 2022. They're in a 20 billion share repurchase and dividend process over the next 3 years. They're getting new active reward memberships to 25 million, which is up 28% year over year. And that's really solid stuff on this stock. Now let's go ahead and talk about dividend stock number 2, and that's going to be the Home Depot, ticker HD. Now I am focusing on Home Depot. I also do like Lowe's, but we're going to be talking about a reason why I kind of like Home Depot more in this current timing. So let's get straight into it. The stock is down 10.6% over the past month alone, a forward PE of 22, a yield of 1.89%, and a market cap of $364.5 billion. So let's go ahead and look at their dividends. They have some pretty, not the best dividend grades as well, but that's okay. They have a payout ratio of 43%, so a definitely sustainable dividend growth rate over the past 5 years of 19%. Really, really good stuff, and a growth streak record of 12 years. Now, fair value on Morningstar is not the best, 244 compared to their last close of 349, while they currently trade for 345. So they say Home Depot's at a 43% premium. But one thing I will kind of mention, and this might be just me kind of being biased towards Home Depot, but their analyst note isn't necessarily about the company. It's just about tax increases, and they're kind of taking this tax and bashing it on a Home Depot. But when you think about it, every single company has to deal with this problem. So when you look at the intrinsics of the company, I don't think that that's a real big problem. So that could be a major offset onto why Home Depot has that fair value rating. But what I really want to point out is this. Other internal catalysts for top-line growth could come from the firm's efficient supply chain. And supply chain right now is huge. Like, there's a ton of supply chain issues going on around the world and going on with different companies. And so having Home Depot's good supply chain is going to be a must in order to stay winning in this industry. Now, including its $8 billion acquisition of Home HD Supply, a provider of maintenance, repair, and operations products, it gives them more potential demand over the next few years and just long term. Home builder Lennar said it sees a strong housing market across the country and believes pricing should remain robust as short supply is likely to remain the same for some time to come. This leads to Home Depot having a massive moat and that short supply they can keep grasp of, and also second, their good supply chain management, which should be making them able to perform solid in this next few years. Now, looking on to some profit margins, they have better margins than Lowe's. Lowe's profit margins, I want to say 8%, while Home Depot's is on the brink of 11%. Return on assets and revenue growth, earnings growth, really good. Free cash flow, solid stuff. Now, here's something that stood out to me. The Home Depot introduces new and enhanced credit options for pro customers. So what this gives me is, one, with pro customers, for example, just companies who maybe are construction companies and they have to buy a ton of home repair equipment and different things like that. Well, there's a new credit option for them, and it brings, one, customer loyalty, and two, potential for more money coming in, just as these people see these credit options and the rewards, and they might be willing to spend more money at Home Depot. So that's a very big thing in my personal opinion. Revenue, year-over-year growth, insane. I really like to see this type of stuff. Home Depot's earnings expectations and revenue growth is 13.7% this year. In 2023, it's only 2.4%, but I do think that this number will increase just as time goes on and analysts will start to bump up their estimates for revenue. But everybody, that's going to be it for this video. So if you enjoyed it, make sure to subscribe to the channel, turn on post notifications for all future videos. Check out the links in the description below, like M1 Finance. If you want to sign up, deposit $100, you'll get a free $50 in your account, 50. Make sure to check it out and leave a comment if you're buying any stocks on this dip. Maybe which one you prefer at a Home Depot or Starbucks. I'd like to hear your guys' input. Thank you so much, and make sure to check out my other investing channel called Investing Alpha. It's just more about growth investing and different things like that. And I do believe there are some growth stocks you can capitalize on in this market. So make sure to check that out. And again, thank you for making it to the end of the video, and I will see you at the next one.